You check your account on a Tuesday night, the way you always do, half out of habit and half out of hope. Your paycheck contribution that month was $400, but the balance is up by $610. You scroll up to see if you mistyped something. You didn't. The market simply did more for your account this month than you did. For years, the relationship felt obvious. You put money in, the number went up. You skip a contribution, the number barely moves. The account felt like a machine you were feeding, and the growth felt proportional to how hard you fed it. That belief was not wrong. Early on, it was almost entirely true. But somewhere along the way, without an alert, without a headline, without anyone telling you it happened, the machine changed how it works. The dollars sitting inside your account started producing more growth in a single year than you were capable of adding through work. And once that happens, it does not go back to the way it was. At least not permanently. Something structural shifted. Most people never notice the exact month it happened. They just notice, one day, that their portfolio feels less like a savings account and more like its own entity, moving with a life that has nothing to do with their paycheck. The question is not really, does this happen? It obviously does eventually for anyone who keeps investing long enough. The real question is what actually causes it, whether there is a moment you can identify in advance, and what changes in your financial life once your money starts outworking you. That last part matters more than people think. Because crossing this line does not just change a number on a screen. It changes what kind of risk you're exposed to, how a bad year feels in your gut, and how much your future now depends on decisions you already made rather than decisions you're about to make. Start with the mechanism, because it's simpler than it sounds and more precise than most people assume. Your portfolio grows from two separate sources. One is your own contribution, the money you physically move from your paycheck or your business into your investment account. The other is investment return, the growth generated by the money that's already there, compounding on itself whether you show up or not. In the early years, contributions dominate because there simply isn't much principal yet to generate a return. 10% growth on $2,000 is $200. That's smaller than what most people can add in a single month. So contributions win, easily, for a long time. But investment growth compounds on a rising base, while contributions for most people rise much more slowly, usually only in step with income. At some point, the math flips. Growth on the existing balance becomes larger than what you're capable of adding. This is sometimes called the crossover point, and it can be described with a formula simple enough to do in your head. Your annual investment growth equals your balance multiplied by your assumed rate of return. Your annual contribution is a separate, roughly fixed number, at least in the short run. The crossover happens when those two numbers meet, when balance times return rate equals your yearly contribution. Rearranged, that means the crossover balance equals your annual contribution divided by your expected rate of return. That single equation is the entire mechanism behind the title of this video. Everything else is detail. Here is where the math becomes useful instead of abstract. Say you're contributing $6,000 a year, $500 a month, and you're using somewhere around 7% as a hypothetical long-run annual return before inflation, taxes, and fees. That is not a prediction for any specific year. It is simply an assumption we can use to illustrate the math. Divide 6,000 by 7%. The crossover balance is roughly $85,700. That number should surprise you a little, because it's smaller than most people expect. It's not $1 million. It's not even close. It's a balance a disciplined saver in their late 20s or early 30s can realistically reach. At roughly $86,000, a hypothetical 7% annual return would generate about $6,000, the same amount you're contributing in a year. But that does not mean the market will actually produce $6,000 every year. Real returns are uneven. Your effort, the thing you've been proud of, the automatic transfers, the discipline. The sacrifice starts contributing a smaller share of your own progress than the market itself does, on average, over time. That's not a demotion, it's the entire point of investing. But it is a real shift, and almost nobody marks the date it happens. And remember, $86,000 is not a magic balance. It is simply the balance where a hypothetical 7% return equals a $6,000 annual contribution. In the real market, you might make $15,000 one year, lose $20,000 the next, and make almost nothing the year after that. Now push the number further, because the crossover point moves depending on two variables you control, and one you don't. The two you control are your contribution amount and, indirectly, your asset allocation, which shapes your expected return. The one you don't control is what the market actually does in any given year, which almost never matches the long-run average. Raise your contribution to $12,000 a year, still at 7%, and your crossover balance roughly doubles, to about $171,000. You'd assume that more saving delays the crossover, and mathematically, it does a bigger contribution needs a bigger balance to be outweighed. But this reveals something counterintuitive. Aggressive savers, the ones doing everything right, often experience the crossover later than more moderate savers with the same portfolio size, simply because their own contribution bar is set higher. Meanwhile, someone contributing a smaller amount but starting earlier can cross the threshold sooner, purely because compounding had more years to work on a smaller ongoing input. The crossover point is not a reward for effort. It's a mathematical relationship between two numbers, not an achievement, not a failure, just an event. Now change the return assumption instead of the contribution. If your portfolio is allocated more conservatively, say a blended assumption closer to 4 or 5% because of a heavier bond allocation, that same $6,000 contributor doesn't cross over at $86,000. They cross over somewhere between $120,000 and $150,000 because a lower expected return requires a larger balance to produce the same dollar growth. This is the part almost nobody accounts for. Your allocation doesn't just affect your risk. It directly moves the size of the account, where your effort stops being the majority driver of your progress. A more conservative portfolio delays the crossover. A more aggressive one, assuming the higher expected return materializes, can pull it forward while also making the ride to get there considerably rougher. A higher assumed return moves the mathematical crossover lower, but taking more investment risk simply to reach that point faster would be the wrong conclusion. There is no universally correct crossover balance. There's only your crossover balance, built from your specific contribution rate and your specific assumptions. Anyone who gives you one fixed dollar figure as the moment your portfolio takes over is oversimplifying a fact of arithmetic into a piece of financial folklore. If you're finding this useful, it's worth sticking around for the next part, because the crossover point is where most people's intuition about risk quietly becomes outdated, and that part matters more than the number itself. Here's where the real complication begins, because everything above assumed a smooth average return. Markets don't deliver averages. They deliver a jagged sequence of good years, flat years, and bad years that only average out over long stretches of time. That single fact turns a clean formula into something messier and more important. Before the crossover, contributions can still meaningfully offset a bad market year. If your balance is $30,000 and the market drops 15%, you lose about $4,500 in paper value while you're simultaneously adding $6,000 a year in fresh contributions. Your own saving behavior can outrun the damage. After the crossover, the relationship inverts. Once your balance is large enough that market growth exceeds your contributions in a good year. It's also large enough that market losses exceed your contributions in a bad one. A 15% decline on $200,000 is $30,000, 5 times your annual contribution. No amount of disciplined saving in that calendar year offsets what the market just did in the other direction. This is the second-order effect almost nobody talks about when they discuss the crossover point as a milestone worth celebrating. Crossing it means the market's behavior now matters more to your year-to-year results than your own behavior does. That's true in both directions during rallies and during corrections. Your effort didn't stop mattering. It just stopped being the dominant variable. Psychologically, this is a harder adjustment than people expect. For years, you controlled the primary lever of your own progress, how much you contributed. After the crossover, the primary lever becomes something you can't directly touch: market pricing, interest rates, corporate earnings, global sentiment. Investors who don't recognize this shift often respond in one of two unhelpful ways. Some become anxious and start checking their accounts daily, mistaking normal volatility for a personal failure, as if a bad month means they did something wrong. They didn't. A portfolio that's grown large enough to outgrow your contributions is, by definition, going to move around more in absolute dollars, even though nothing about your habits changed. Others swing the opposite way. Once they see that market growth dwarfs their own contributions, they quietly reduce or stop contributing, reasoning that their money is big enough to grow on its own now. This is where nuance becomes essential, because that instinct, while understandable, ignores three things the crossover point does not change. It doesn't eliminate sequence risk, the danger of experiencing a downturn at a vulnerable point in your timeline. It doesn't guarantee that the assumed rate of return shows up in any specific year. And it doesn't replace the compounding benefit of continued contributions, which still meaningfully shortens the distance to your long-term goals. Especially when markets are flat or declining and your contributions are the only thing still moving the account forward. Some of the most valuable contributing you'll ever do happens after the crossover point, not before it. Continued contributions during a downturn buy more shares at lower prices, although nobody knows in advance when a downturn will end. The crossover doesn't make contributions unimportant. It changes their job. Before the crossover, contributions are the main engine. After it, they become the stabilizer, the part of your strategy that keeps functioning regardless of what the market is doing in any given month. There's a practical way to see this play out. Picture two investors, both 30 years old, both contributing $500 a month into a diversified portfolio. Investor 1 starts with a $10,000 balance already saved. Investor 2 starts from zero. Investor 1 reaches the roughly $86,000 crossover point in a little under 9 years, somewhere around age 38, assuming steady average growth. Investor 2, starting from nothing, takes closer to 11 years, crossing over around age 41. A $10,000 head start moved the crossover date forward by roughly 2 years, not because Investor 1 saved more monthly, but because compounding had more raw material to work with from day one. Neither investor did anything wrong. But the numbers show something important. The crossover point rewards early principal more than it rewards later intensity. A dollar invested at 25 does more work toward reaching this threshold than a dollar invested at 35, even if the 35-year-old contributes more per month. Time in the account, not just money into the account, is the variable most responsible for how soon this shift happens. This is also where the popular idea of the exact moment needs a correction. There isn't one clean date on a calendar. Because markets fluctuate, an account can technically cross the threshold in a strong month, then fall back below it during a correction, then cross again the following year. The crossover isn't a single doorway you walk through once. In the years surrounding it, your account behaves like it's straddling a threshold. Some months your contribution wins. Some months the market wins, and the balance of power gradually, unevenly, tilts toward the market as your principal keeps growing. Once you're 5 or 10 years past the initial crossing, though, the shift becomes durable. The gap between what the market can generate on a large balance and what you can personally contribute keeps widening. Because your contribution grows with your income, usually a few percent a year, while your principal, if invested reasonably, tends to grow at a materially faster long-run pace. That widening gap is why, decades into a career, someone's account can grow by tens of thousands of dollars in a single strong year, an amount that would have taken them years of saving to accumulate in their 20s. So what should you actually take from this, practically, without turning it into either a reason to celebrate or a reason to stop paying attention? First, calculate your own crossover point, using your real contribution amount and a return assumption appropriate to your actual allocation, not an optimistic guess. It's one division problem. Your annual contribution divided by your expected rate of return. That number tells you, roughly, the account size at which market performance starts outweighing your own saving behavior in a typical year. Second, understand this. The crossover isn't a finish line. It's a transition into a phase where your dollar value swings get larger. Your emotional reactions need to get steadier, and your contributions shift from being your primary growth engine to being your defense against bad timing. The people who struggle most after this threshold aren't the ones who saved too little. They're the ones who expected the old rules to keep applying, then got surprised when a single quarter moved their balance by more than a year of their own effort ever did. Third, resist the urge to treat proximity to the crossover as a reason to change your allocation dramatically in either direction. Investors sometimes get more conservative right as they approach this point, worried about protecting new, large gains, even though their time horizon hasn't actually changed. Others get more aggressive, chasing the feeling of watching the market do the heavy lifting. Neither instinct is wrong on its own, but neither should be driven by the crossover point itself. Your allocation should be driven by your time horizon, and your capacity to withstand volatility. The crossover just changes how visible that volatility becomes in dollar terms. Go back to that Tuesday night, checking the account, seeing $610 of growth against a $400 contribution. It felt like a strange kind of victory, but also slightly unsettling, like watching something you built start moving on its own. That feeling is accurate. What changed wasn't your discipline. It wasn't a reward for good behavior, and it wasn't luck either. It was arithmetic finally catching up to years of patient, boring, repeated contributions that felt, at the time, too small to matter. The exact moment your portfolio starts growing faster than your contributions isn't really about a specific balance or a specific age. It's the moment your past decisions start outweighing your present ones, the point where the money you already put in becomes more influential than the money you're still capable of adding. You didn't stop being the reason your account grows. You just stopped being the main one. And understanding that difference, long before it happens, is what lets you experience it as clarity instead of confusion when it finally does.